Welcome back, investors, to Fiscal Voyage. I'm Felix. In this video, we're going to talk about a company that's been growing dividends for 38 consecutive years. They are also part of the Dividend Aristocrat list, which are companies that's been growing dividends for 25 consecutive years or more. And if this is your first time here to this channel, make sure to subscribe, because tomorrow I'm going to be posting another video of the next Dividend Aristocrat. And also in the description, you'll see the previous part 1, part 2, and part 3 of the Dividend Aristocrat list. This company is called AFL Incorporated. So let's get started with the stock analysis. And watch towards the end, because I'm going to provide you with a fair value price and my recommendation if it's a hold, buy, or sell. AFL Incorporated, ticker symbol AFL. I'm sure you guys heard of AFL with all the commercials with the AFL duck. But did you know AFL actually stands for American Family Life Insurance Company? A little FYI there. The company is an insurance company and is the largest provider in supplemental insurance in the United States. And in the US, AFL underwrites a wide range of insurance policy, but is perhaps well known for its payroll deductions insurance coverage, which pays cash benefits when a policyholder has a covered accident or illness. All right, let's go ahead with the fundamentals. From the period of 2010 to 2019, revenue grew at only a compound rate of 0.8%, so basically flat. AFL, as you may not be aware of, it's not really a growth company. It's more of consistent, 5-6% growth in earnings. But net income grew at 4% in that same time period, and it currently has an S&P credit rating of A-, which is great credit ratings. And in this 10-year period, earnings grew at 5.3%, which is decent. Like I mentioned, it's not a big growth company, but it's a nice consistent growth. For the past 5 years, revenue had a 5-year average of 1.6%, net income at 6.9% in the 5-year period, and earnings at 6.8%. So we continue with the fundamentals. For 2019, earnings was $4.42. Net margin came in at 14.9%, which was higher than 2018 fiscal year, which was 13.5%. So net margin grew slightly there. Return on equity at 12.6%, which is right in line with their history. And currently the company has a decent yield at 3.01. The yield is not outstanding, but it's a nice dividend yield of 3%. It is higher than the S&P average, but 3% is still decent. The 5-year growth rate for the dividends was 7.9%, basically 8%, which is nice. That's exactly where I want to be at. That's the sweet spot, 7, 8, 9%. If you find a company growing it at that rate with a nice 3 to 4% yield, you could double your income in 10 years or so. And the company has a dividend payout ratio of only 26%, which is very low. So that means the dividend is very well covered, and this is based on 2020 expected earnings. And the company has been growing dividends for 38 consecutive years. So it's been growing dividends older than I've been alive. So that's some interesting there. A lot of these Dividend Aristocrat has been growing dividends, more than 25 years, 30 years, 40 years, some of them. So this is great there. The charter rule comes in at 10.9, so it's right there where we have my criteria at 10, 11, maybe even 12. So like I said, the yield is what's hurting it here, because the growth rate is pretty decent. The 5-year dividend yield average is 2.27%, so it is higher, the current yield versus the 5-year average, so that's a plus there. And the most recent increase was at February, 3.7%. So that's right there, shows you the strength of the company. Even during this pandemic, they increased the dividend. It wasn't an exceptional rate, but a 3.7%, I'll take it, especially in this time of crisis. If we look at the balance sheet, debt to cap is at only 20%, and the total asset divided by current liabilities at 1.2, which is a little concerning here. I like to see it at 1.5 or higher, but 1.2 is okay for this company because of the fact that it's a A- credit rating, low debt to capital, So I like that. Debt to equity at 0.26, so that's very low. That's good there. And price to book, the company right now goes for 1.01, which is below the 5-year average of 1.42. All right, so we go to future outlook. This is what analysts are expecting Aflac to earn in 2020, $4.35, and 2021, $4.47. For this year, it is lower than 2019, which they earned $4.42. However, it's only a small decrease versus a lot of other companies that's out there during this pandemic. So I'm okay with this. 2021, they're expected to be higher than 2019, so that's a plus there. And CFRA has a projected earning growth of 5%. So again, this is not a real growth company. This is your slow and steady growth here. 5-6% of growth for the foreseeable future because it is a pretty big company. However, my dividend drill return model came in a 12.8% projected total returns. We'll see that in the fast graph shortly. Forward PE has an 8.4 versus the current PE of 8.46. That's okay, and it's much lower than the 5-year PE average of 10.8. So based on PE, based on dividend yield, it looks like the company is undervalued. So we look at the fast graph. As you can see here, the black line is the monthly closing price. The orange is a earnings with a multiple of 15, and the blue is the normal PE of 10. So the market tends to favor Aflac at a 10.6 multiple to earnings. As you can see here, so Aflac tends to pretty much follow that blue line pretty good. Right now it's below both the blue and the orange, so that's a pretty good indicator that it's undervalued. And as you can see, 2020 they're expected to earn $4.35, which is negative 2% less than last year earnings. So it's not that bad, 2%, considering the economy was pretty much shut down for 2 months and still pretty on phases right now. But you can see that the projected total return is 32%. Based on 2021 earnings of $4.47. So this came to fruition. You see some pretty nice return based on this price. And on the top right, you see the blended adjusted earnings yield of 11.8. So that's very attractive there. I'd like to see it at 7% or higher, 6% or higher. So that's very good there. Like I mentioned before, as you can see, earnings growth rate at only 3.54%. So again, it's not a big growth company, but it is a steady company. In 5-10 years, you'll definitely be making money purchasing this shares of this company here. If we go to our fair price shot here, CFRA has a fair price of $34.59. Morningstar at 47. Fast Graph, as we saw, at $46.18. Yahoo at 41.83. And my dividend discount model analysis, $30.22. For my analysis, I use a 6% growth rate for the next 3 years and 5% after that, with a discount rate of 9%. I use a 6% growth rate for the next 3 years because of the slow growth. They increased the dividends of 3% earlier this year. I'm expecting kind of the same thing, 4%, maybe 5% next year, and then picking it up after that. So I more or less 6% should be fair and conservative here. And averaging out to 5, we get a fair price of $39.97. And the current price, Aflac goes for 36.72 cents. So that means it's undervalued by 8.9%. So with that, my recommendation is a hold. So as you just saw, I have a hold recommendation for Aflac. The reason for this is because the company is not a tremendously high growth company. It's fairly, I'm sure you'd be able to make money if you were purchasing it today in 5 years or even 3 years. I see the potential to make money here. I actually own shares of Aflac, but I bought it back maybe like in 5 years ago. I have a share basis point of $30 a share. But I wouldn't buy it at this prices because I find it that in today's market, there's a lot more better potential where I could invest my money and get better returns. But if you're looking for a very safe company, this is definitely one of those. The dividend yield is decent at 3%. The growth rate of the dividend is nice. The 5-year average was about 8 or 9%. And they raised the dividend earlier in February at a rate of 3.7%. So overall, this is a great company to own. That's why I actually have it in my portfolio. But at this prices, I'm kind of like, meh. I could find better opportunity elsewhere, so I wouldn't recommend it buying it right now. Maybe if it dropped to $32, $30 a share, then I'll be more interested. But right now I'm kind of like, you make money, but there's better potential elsewhere. So remember, again, holds are just added into your watch list and for further research, and maybe have a price point about $32, $30, and do your research. So stay tuned for tomorrow's video. We're gonna do the next Dividend Aristocrat. Make sure to like and subscribe to the channel if you haven't already, and I'll see you guys in the next video.